Good morning and welcome to the Homestead CPA. My name is Dan Snyder. If you've been with us before, welcome back. If you're new to the channel, welcome. Today we're covering part 11 in the 15-part video series on accounting, tax, and legal issues for homesteaders. It's just after New Year, so I hope you had a wonderful New Year, and 2025 is a fantastic year for you. Today we're going to talk about the thing that we love to hate, and that's income. We all love income. We want to have lots of it. What we hate is paying the taxes on that income. But let's talk about what is income and how do we report it and when do we report it. So income is basically anything that you earn. In the United States, there are very, very few exceptions. That's all income. There are a few things that aren't taxable income, but for this purpose, for our discussion today, any money that you make in your homesteading activity is going to be taxable. So the question is, what is it and when is it taxable? So let's take as an example, let's say you're raising turkeys to sell. Now, if someone comes to your farm and you sell them a turkey, they hand you money, you hand them a turkey, whether alive or processed, that's income. You've received the cash, it's in your hand, ready to go. But maybe a bit different. Let's say that instead of paying you when they take the turkey, let's say you require a deposit. And so in May, you require any customers to give you a 50% deposit. So let's say you take a $40 deposit for that turkey. Is that taxable to you in May? Well, that depends. Is the payment that you have been made refundable or not? If the payment is refundable, then it's not income to you until you actually deliver the turkey. So if you receive the deposit in May, you deliver the turkey in October, and the rest of the money is paid then the money that was paid as a deposit is going to be income at that time in October, not in May. Now, if it's in the same year, there may not be a massive difference, but if it were to cross years, let's say that perhaps you were doing an animal share that you took a deposit in June or July and then didn't deliver the animal until February the following year, well, is the deposit included in the first tax year or the second? It goes back to, is the deposit refundable? If there is a possibility that you have to give that money back, then it's not income until the possibility that you have to give it back goes away. All right, now that's a fairly simple, straightforward process, but let's think about another example. Let's say you've decided you're going to buy a new trailer, and a friend of yours comes up and says, hey, I want to buy your old cattle trailer. Will you sell it to me? And you say, sure, fine, that'll help me pay for my new trailer. And he says, yeah, but I don't actually have the money to pay for all of it today. Could you carry the note for me, basically? And you agree to carry the note. Well, what happens? If you sell the trailer and you get, let's say you sold it to them for $40,000, very nice trailer, and they give you $5,000 down, and they're going to pay the remainder out over a period of, say, 5 years. Well, they're going to be making monthly payments to you. What is that monthly payment? You're going to be charging them interest on this note that you're carrying, and a portion of each payment is going to be interest, and the remainder is going to be principal. So from a tax perspective, normally, as in this case, you would record the entire gain, the entire $40,000 in the year that you initially sold the trailer. However, you can make what's known as an election to treat the sale as an installment sale, and then in that case, you would only pick up the income as you receive it. So let's say that you received $5,000 plus, say, 4 payments of $400, and you've received $6,600 in the first year. That's what you report. Then each year, if you're getting $400 a month, you're going to record another $4,800 worth of income during the year until the trailer's paid for. Now, to determine the gain, you got to look at what you paid for the trailer versus what you sold it for. If you paid $50,000 for the trailer and sold it for 40, then you won't have a gain. But if you paid $50,000 and took a depreciation deduction, as we talked about in a previous video, then you may have no remaining tax cost. You may have written off the trailer all in 1 year, for example, in which case the entire amount of the payments are going to be taxable income to you. It's going to be a gain. So that is an option. Generally, we like the idea of spreading gains out over a longer period of time so we don't have to pay as high a tax rate on the income. But perhaps in the year that you're selling the trailer, maybe for some reason you had a loss, or you disposed of some other property that had a loss involved, or you sold some shares that had gone down in value, then it might make sense to go ahead and take the entire gain, even though you could spread it out. Because remember, that's an election. You don't have to do it. Obviously, you'll need to talk to your tax advisor about this. And in fact, our next video is going to be covering how do I find a good advisor, whether it's an accountant, a tax advisor, or a lawyer. How do I find someone in my area that can help me? The last thing that comes up generally in the homesteading, specifically in the homesteading, if you will, business, is there are sometimes legal issues involved in how you sell something. And so let me tell you what I mean. For example, in Texas, I can have a steer processed for my family, for my own personal consumption, and the meat doesn't have to be inspected because it's for my personal consumption. But if I'm going to sell the meat, then I have to have an inspector watch the animal be killed, and an inspector inspect the meat. And obviously there's fees involved in that before I sell the meat. So what if I don't want to pay all those extra fees? Is there a way to get around that? Well, the basic way for doing that is by selling all or a portion of an animal to someone else, so that when that animal is taken in to be processed, it is being owned by a number of different people. So let's say you had two people that each owned a pig. You kept half and you sold half to your neighbor. And when that processor is asking, how do you want this pig to be processed? You're going to tell him how you want your half done. And the other person is going to tell him how he wants his half done. And he's going to pay the processing fees. You pay the processing fees for your half. And the person who bought the other half of the animal is going to pay the processing fees for their half. That way, once again, because each of you are having your animal processed for your own personal consumption, then there's not a requirement that they be inspected. This is something you're going to want to speak to, however, to your local legal advisor, because this rule may be different in your state than it is in Texas. So every state is different. Every state may have its own rules on matters like this. Finally, what if somebody pays you with a credit card? Does it make a difference? What about PayPal? When you receive the money, as we talked about earlier, it's income. Well, does it matter if they send me a check? If they mail me a check, if the check is dated December 31st, but I don't receive it until January 4th, when do I include that as income? Well, you include it when you receive it. What about PayPal? If somebody sends me PayPal and I choose, and it comes to me and they send it in December and I receive it in January, once again, I've received it in January. But there's some exceptions to that, or different things that you need to keep in mind. What about Cash App? So if somebody pays me via Cash App, I have a choice. I can wait 3 days and receive all of my money, or I can take the money right away and pay a fee. In that situation, if you have the ability to take the money right away, it is taxable on the day that you have the ability to take the money from the system. So just be careful with how you process any payments like that. So fairly simple, fairly straightforward. As I said, good news, bad news. Why would I worry? Why would I care? Well, because I want to make sure that I'm reporting income from my activity in the year that makes the most sense for me from a tax perspective. So if you have, especially towards the end of the year, the possibility of having a fairly significant amount of income, call your advisor, talk to them, say, hey, here's where I am right now. I've got this amount of money that I could either maybe get this year or maybe get next year. What should I do? And let him run some numbers for you and give you some advice. Remember, none of us like to pay taxes, but as always, even Jesus paid taxes.